I am Ryan Nauman, Zephyr's market strategist, and your guide through the fascinating world of separately managed accounts. Each month, we dive into strategies behind the numbers and chat with award winning SMA managers to give you actionable intelligence backed by 4 decades of PSN performance data. So, whether you're an asset manager, advisor, or institutional investor, consider this your VIP access to the SMA universe. Today, we're going to shine the spotlight on Ranger Investment Management. During this conversation, we're going to take a deep dive into the firm, the people, and their micro cap growth investing strategy. But first, Inside SMAs is brought to you by Zephyr's PSN. For 4 decades, PSN has been a top resource for investment professionals looking for managed account research and data. Asset and wealth managers rely on Zephyr's PSN to effectively reach institutional and retail investors. All right, enough from me. Let's bring on the star of the show. I'd like to give a very warm welcome to Conrad Doenges. Conrad is a Chief Investment Officer and Portfolio Manager at Ranger Investment Management. Conrad, thank you so much for coming on the show. It's an honor to have you on. I'm really excited about this conversation. Learn more about your investment philosophy within microcaps. Really excited for it. Can you please tell us a little bit more about yourself in Ranger Investment Management?
Sure. First, Ryan, thank you for this opportunity. It's a great honor to be on this podcast. I've been at this for 37 years and at Ranger Investment Management for 22 of
Wow.
those 37 years. We founded the firm back in our track record, and our small cap product goes back to 2003, and micro cap, which we're discussing today, dates back to August 2014. So we have a very experienced and tenured team that's been very stable over the years, and I look forward to explaining our philosophy and strategy.
Yeah, that's fantastic. I love that you brought up a stable team. Doesn't sound like there's a lot of turnover, which is fantastic because when I do due diligence on a manager, that's one thing I look at is there much turnover within the firm, whether it's on the investment management team or just the firm, the executives. So I love that you just started off by saying it's been a stable firm over these years. So it's fantastic. So let's continue with the firm level and talk about the firm personnel. Can you maybe tell us a little bit more about the makeup of Ranger Investments, maybe the number of people, operations, and their tenure?
Sure. There are 10 members of the investment team. We're the majority of the boutique. And then in the operational side of the business, there are another 6 individuals. So we are truly a boutique, total assets under management and advisement just under 2 billion at the end of last quarter. There are 4 of us that have worked together for 22 years,
Okay.
all of us members of the investment team. We're employee owned. We all of us own the firm. 10 are partners of the total employees. We feel that that induces not only stability, but also directly aligns our interests with those of our clients. And as you mentioned, very little turnover. There are only 3 members of the investment team that have left over the last 22 years, and they were all 3 asked to leave by me. Nobody has gone across the street to set up, another shop or to join another firm. So we're quite proud of the fact that once people come, they want to stay and be part of the Ranger investment team.
Yeah, that's fantastic. It is a boutique. It's a small firm. On the operation side, you said there's 6 people, I believe. Let's say after this episode, we post it, you get a huge influx of new assets. A lot of people come, new assets, new accounts. Do you believe that 6 people and then the 10 people on the investment management side, do you believe that's enough staff to handle an influx of assets or new accounts?
Absolutely. We have the capacity, most importantly, capacity for our products is defined by limitations that we do place on ourselves on the amount of assets that we'll raise. And it's a function of limiting illiquid securities in each of the portfolios to 10%.
Okay.
So, and we could more than double from here, with our existing products. And so with the personnel that we have in hand, you know, if we did have an influx of clients, maybe we need to hire some more people in client relations and marketing. But as far as the investment team goes, which is, manufacturing and putting together the portfolios and trading and everything that's key and important, we are well staffed. And with technology today, you can do so much with fewer people. And rest assured that our clients in the SMA market have done a considerable amount of due diligence on us, and are all confident that we have the right personnel in place, to achieve our fiduciary duty to them. And these are Fortune 100 companies that we manage assets for. And the consultants that work with them have all done extensive research on us. So we feel very confident and comfortable that we have the capabilities.
Yeah, that's fantastic, Conrad. I'm glad you brought that up about the due diligence in those big firms, endowments, or institutions. They feel comfortable, consultants feel comfortable with your structure too. And like you said, technology is huge to range, or it sounds like you're adopting technology to help you with it.
Absolutely. Yes.
So at the open, I mentioned that we're going to focus on the micro cap growth strategy, which has been named a PSN Top Gun over numerous periods. And most recently, it was named the Manager of the Decade for the micro cap universe. So, congratulations. I told you earlier, I think that Manager of the Decade is a great award because it measures consistency and performance over 10 years, which is very hard to do, especially these past 10 years that we've gone through in this market. You mentioned 10 people on the investment management team. Is that 10 people also managing your growth strategy? Or can you give us a little bit more information on that makeup of the microcap
Yes.
growth strategy?
All 10 of us on the investment team are involved with both our small cap and our
Okay.
micro cap. We're divided as sector managers or analysts that break down coverage by our respective area of expertise. The team is very tenured, and with four of us working together for 22 years, and the other members of the team coming to us with experience and background in the areas that they cover, we know our universes well. We work very collaboratively, which is important, and how we manage the portfolios, and shared, research insights daily on what's going on in our respective areas of coverage.
Fantastic. So that was going to be my next question is with a 10-person investment management team, how do you find good investment opportunities within an asset class that might be harder to locate data or good data and information? And obviously, that gives opportunity to find alpha and inconsistencies. But I think you answer that question in terms of those 10 people, you have dedicated spaces, parts of maybe microcap that you are subject matter experts in. Is that really how you find and locate those good opportunities? Is you rely on each person to have their subject matter expertise in that space?
We know our universe. We know the companies that fall within the market cap spectrum of microcap, and there are literally thousands of companies that we could invest in. There's not a lack of companies to choose from, but we're a quality growth investor, and as a quality growth investor, there are certain financial criteria that are necessary to become part of the portfolio. So when you start with a wide universe and then apply, companies that have clean balance sheets, that are generating cash flow, that have earnings, that have revenue growth, you narrow that universe down considerably. And then apply on top of that quantitative, analysis, a qualitative analysis of us speaking with the management team, getting comfortable with their accounting practices, with their corporate governance, that whittles it down even further. So we believe in running concentrated portfolios, and our microcap strategy has averaged 40 positions over the last decade. And that's compared with many who approach the microcap universe by, building portfolios that have 100 or 150 names. And it might seem counterintuitive, but with fewer names, we're able that are quality. We have really a real good risk profile with a lot less volatility and very good downside protection because of the attributes that we find attractive to invest in. And and so I think that's one big reason we've been able to manage through such an interesting environment over the last decade and generate the performance returns that we've been able to, to put up on an annual basis is just because of what it is necessary for a company to have to qualify as an investment in our portfolio.
Yeah, that's fantastic, Conrad. So my next question was going to be about the investment philosophy. You mentioned quality growth. You're very particular on the companies that you're going to invest in because they have to be quality balance sheets. Their financials have to be solid. How does that differ from your peers? And maybe go in a little bit more detail about your investment philosophy, but you mentioned your peers, usually they're bigger portfolios, over 100 names. I'm sure a smaller portfolio can add more active share to it, higher tracking error. Can you go a little bit more into those details?
I can't speak specifically for my peers, but the way that we approach it is if you're looking at a sector level at investments in building out the portfolio, we like well diversified portfolios. So we try to invest across the broad all the sectors that we can and have that disparate exposure. But as we narrow the universe down, and let's, you know, say it's a regional bank or a retailer, we, if you find a best in class company that's within the market cap range where we invest, and you can build that out, in our microcap product, anywhere from a 1% up to we have a maximum of 7% weighting. It's very rare that we get up to that level, but that can represent a large portion of the portfolio and drive performance. And if you have just two or three companies in a respective sector, you can have, in many cases, full exposure.
Yeah.
And we don't see any reason to own the third, fourth, or fifth best name in an industry when you can own the singular best. And finding a singular best in microcap is hard because they're not, these are companies that are, much earlier in their life cycle or have been around for a long time and, are, waiting for some sort of catalytic change for their company to be recognized. And so one of the important things that we've learned is when we find these companies, many times they're not well covered by Wall Street, which is a huge opportunity, and you have to be patient for that discovery period of when people wake up to the good results that the company is generating and it gets people's attention. And you never know quite when that catalyst is going to occur, but when it does, you have the combination of not only fundamental improvement but multiple expansion as more people gain interest in the company, which is a powerful combination and leads to the good absolute returns that we can generate.
I love that you talked about these microcap companies. They're not followed by Wall Street as widely as your large caps. So with that, I'm assuming, you know, Inefficiencies tend to be harder to find in asset classes like more efficient large cap blend or large cap growth because there's so much data, they're covered by Wall Street. Where do you find market inefficiencies when investing in microcaps? I'm assuming you got to do more work, but it's easier to find. They're not covered, they don't have analysts covering them. Where do you find those inefficiencies?
Exactly as you said, and they're not being a lot published on the companies. So we are, we tend to be very wonkish in how we go about our process. You know, you start by reading SEC filings to learn about a company. In this day and age, the amount of information that you can find on a company just through public documents is tremendous.
Yeah.
And as you gain this understanding of the company's business, and then you follow up and have discussions with the management team and get to know them over an extended period of time, and you see how they execute or don't, then that leads ultimately to not only potentially being part of the portfolio, but also what percentage of the portfolio it represents. And and so that's an important way that we manage risk, and it a lot of it gets into in microcap in particular gets into corporate governance. You often find we love founder-led companies, but when you have a founder-led company that still runs it as a private company, and that's a little bit, that's a red flag for us.
Okay.
We want them to understand their duty and responsibility to public shareholders, and so we look at the independence of the board and other factors, whether related party transactions. And if there are multiple yellow or red flags on the governance side, we won't get involved. And so, again, that's a gating feature that allows us to invest in what we deem quality.
Yeah, it all goes back to that quality word.
Yes, it
Yeah.
does.
Like I said earlier, your microcap growth strategy has been named the PSN Manager of the Decade, just ending December 2024 for the microcap PSN universe. What has worked well for the strategy over the past 10 years?
It's been a wide range of, industries. You find so many inefficiencies across each sector. And, first of all, let's start with the microcap growth universe. Nearly 50% of the companies in the index are unprofitable. So eliminate those. And many of them, if you look at, industries like biotech, are binary outcomes. You're waiting for, the result of a drug trial to be positive or not. And those stocks either soar or plummet. And so we stay away from
Okay.
those types of investments. But Joe Labat, who's one of the portfolio managers for the product and who's I've worked with for 22 years and covers healthcare, he's been very successful in positioning us in healthcare, which is the largest sector in the index and has always, for the last decade, has been the largest weighting because it's highly populated with biotech companies. But he has positioned us in companies that sell the tools into the biotech companies,
Okay.
and those are recurring revenue type of stories where you sell a piece of equipment and then you have to have the supplies that they, as they develop the drugs, they have to replenish. And so finding profitable companies in healthcare that have that recurring revenue stream is has been a real key to our success.
Mhm.
Another area that's completely very different would be regional banks. There, If you think of the way we approach it, and again, this is an area that's managed by Andrew Hill, another one of my teammates that's been with the firm since inception and is also one of the portfolio managers. You know, when you find a geography that's expanding, we're based in Dallas, so Texas
Okay.
over the last decade has been a big area of growth and population. You can find regional banks in Dallas or Houston, San Antonio, Austin that are growing and taking market share at the expense of the large
Okay.
banks, Bank of America, or you name the money center bank. And they don't have their eye on, the small businesses. And if they're losing a little percentage in a market, it's not going to matter to them. But that matters a lot to those regional banks. And so they can outgrow their peer, their larger peers with their not being, a target on their chest. And as long as they manage their asset quality well, and we
Yeah.
scrutinize that and do very thorough burn down analysis of credit cycles and credit risks within these regional banks, but they can you know grow at rates that are atypical for a banking company, and take very nice share in very good markets. And on top of that, the US is overbanked. And so you have a lot of consolidation that occurs. And one thing that we've found over the last decade in microcap is that we have a very high hit rate of companies that get purchased by either their larger peers or by private equity. And regional banks has been the number one area where we've seen the most companies that have been purchased by their larger peers. So if a bank wants exposure to Dallas, and we have a regional bank that is here and is growing, and it has all these quality attributes that we like, it should be attractive to that other, or that regional bank that wants to grow its presence here.
Yeah, Conrad, that's fantastic. And let's focus on the banking side for a second. Like you said, on PSN, it shows that financials or banking is one of your top holdings. Number two, I believe it was. And like you said, do you, what do you tell those financial advisors who might be concerned that say, you know what, I'm a little bit concerned about regional banks with all the issues we've had over the past couple of years about regional banks, and now you have this issue about maybe these regional banks investing in some private credit deals that go bad. What do you tell them? You touched on it about your credit analysis that you do on these regional banks, but is there anything more that you can tell them that say, hey, we're okay on these regional banks?
It gets down to not only Andrew Hill's analysis and his credit stress testing. What he starts with in his models is he does, I mentioned earlier, a burn down analysis. And this, we take great financial crisis type conditions and we apply it to the bank that we're considering for investment. And we use that as a potential downside case for the investment. And we look at that risk versus what we know about their reserves, their accruals, and the quality of the loans that they have on their books. And you know speak in depth with management, making sure that they're on top of the loans that they're making. And ultimately it comes down to us doing the work and checking it with through other contacts in talking with other bankers in the industry to understand you know that regional bank's risk profile. Fortunately, with banks, they're highly regulated. You have the FDIC. there's there's a lot that you can learn through government filed documents. So it's being on top of those and speaking regularly with management. and going on site to visit them. We know one thing that we find critical in our analysis is to be on the road, to go visit the companies that we're invested in, multiple times a year, maintaining that consistent dialogue with management and with peers to validate whether, what they're saying is accurate or not.
Fantastic. Good stuff. Let's talk real quickly. Go back to healthcare, your largest sector in the
Yes.
portfolio. I liked what you said about healthcare and some of the issues that go along with investing in healthcare, but also there's a lot of opportunity in healthcare with the adoption of AI. I keep hearing that healthcare is one of those sectors that is adopting AI more so than others. Does that play a role in your overweight, or not necessarily overweight, but your largest sector being healthcare?
AI is really has a huge potential to you know essentially cater or implement drugs that are specific to each individual. And there are software tools and drug development tools that have greatly have matured significantly, but we're still in the very early innings of this. And so what we can find are companies that either develop that are already have established drugs that are being successfully sold on the market, that have revenue and are generating earnings from them. And as I said, those companies that supply into the universe of of biologics, and that will evolve. But right now, as far as the AI software, we just don't have that name right at this point in time. It would be a whether it falls into our market cap and micro cap is the biggest question. And here we're talking companies that, are typically sub 2 billion in market cap. And so if you're a leader in that, area, the likelihood that it's going to be a market cap below 2 billion is probably pretty low.
Very good point. Very good point, Conrad. So we've talked a lot about your long-term performance. It speaks for itself. Let's. I'm gonna ask you a couple more difficult questions, Conrad. Your recent performance, though, has lagged its peers and benchmark over the past, let's say, year and 9 months. What would you tell financial advisors who might be concerned about that recent underperformance when they're looking at trailing returns in the more near term?
Sure. We underperform during periods of speculation,
Okay.
and where beta and momentum lead the market. As a quality growth investor, when you get into thematic markets, everything right now is AI. It's and surrounding themes of quantum and nuclear. When you're talking nuclear, we're talking about companies that have no revenues, obviously no earnings either. And when they're soaring with and represent large portions of our benchmark, the Russell Microcap Growth Index, it's impossible for us to keep up. And we acknowledge it. Our clients know that. And also, when there's concentration in a portfolio, as I said, averaging 40 stocks, you know, often when you're in this sort of market, you know, that is driven by non-earning companies, we're gonna lag.
Mm-hmm.
And but we also know from our downside capture and what in studying this market and having done this for 37 years and 22 at Ranger, what's occurred this year in the market is high beta has versus low beta, has reached one of the rare readings in my career of a 99th percentile. And those events date back to the tech bubble, coming out of the great financial crisis, the June quarter of 2009, when there was all the markets reopened and companies priced for bankruptcy tripled and quadrupled in that quarter. And then the meme stock and SPAC frenzy that you saw in the liquidity driven period post the COVID reopening. And so those are the only occurrences in this most recent one where we've that's occurred in just in the last couple of months where we've reached that 99th percentile reading. They tend to last no longer at the maximum 6 to 8 months. And then gravity takes hold and people look at underlying fundamentals. Valuations ultimately matter. And what I would say is when not knowing when this is this frenzy is going to stop, it ultimately does, but our quality portfolio will hold up well and perform well when these others come down to more reasonable valuations that are, based on their underlying fundamentals.
I've been talking a lot about normalization. Things were not normal following COVID. Interest rates were at zero. I find that when you were talking about that in the two previous times, your examples of post global financial crisis, COVID, interest rates were very low, right? So you feel as if when money is nearly free, it's time for momentum, things get out of whack, it's not normal. Now we're getting time, interest rates are normalizing or have been. So maybe, hopefully, we're getting into more normal times where financial markets are a little bit more normal too.
This is, having done this for so long, there's a whole generation of investors that, you know, that really believe that zero interest rates or,
Yeah.
below 2% was normal. And this normalization of where we are at, 4 or 5% rates, looking over the course of my career, that sort of can even be at the low end of where it's been. And so I remember signing, mortgages going back when I moved to Dallas in the late 90s at a, 7 and 3/8,
Yeah.
rate. And so there, the economy can operate fine with where rates are today. And it, I'm not a macro. My guess is as good as anybody on where rates are headed based on inflation and unemployment. But, the Fed does seem poised to, continue to cut rates, particularly as it relates to employment issues right now. But, to think that we're going back to sub 2% or to 0%, I think is a bit folly. And we have finally reached this level where rates are normal and supply chains now are normal. And you know, it, there was this whole asynchronicity in the market of sectors and parts of sectors not being aligned like they normally are. And so these business cycles got way out of whack from COVID. And I think now that we're, essentially 5 years, past that, it now seems that, everything is sort of back into sync.
Yeah. Yeah. I agree. I agree completely. And uh, it'll be interesting when we get remove ourselves further away from all the weird things that were happening post COVID that we'll start seeing maybe some. I always think during times of crisis or things that are we're good markets, really great markets, economy, things get created that maybe, like you said, there's no earnings growth, there's no revenue, yet they're producing 20, 30% returns. That's not normal. When we get through this normalization, we'll see what's that saying, when the tide goes out, they'll see the rest of the dead bodies or the cockroaches. Right.
Yeah, I mean, the small and micro cap space has been, you know, relatively tough since 2022 when the Fed, raised rates so dramatically. And everybody's been waiting for, okay, now leadership is going to shift from large cap to smaller micro caps. And it's been fits and starts. And the reason it's only been fits and starts and nothing sustained is because there has, as an asset class, smaller companies have not seen earnings growth grow broadly. And so every year you have a lower denominator. And off that lower denominator, people say, okay, now they're going to grow faster than large caps. and what and it doesn't materialize. I think finally, here late in 2025, you have an unusual situation where instead, normally seasonally, you see negative earnings revisions at this time of year. They're positive. And you couple that with favorable tax provisions of the One Big Beautiful Act and what that means for smaller companies. And as we look to 2026, I finally have something tangible that I can hang my hat on, that I can point or you know point to, that could be that driver for smaller companies putting up better than expected financial results and growing, and actually, growing at a faster rate than those of large caps. And, to be determined, but, right now that the backdrop is better than it's been for a number of years. And I think that helps take some of the speculation out of the market. You know, as people, look for just thematic investing, I'm going to own quantum or I'm going to own nuclear. And then they look at, well, I want to own smaller and micro cap companies because they have real fundamentals and growth and they're attractively valued. That for an SMA investor, is much more attractive, as a reason to get involved in the asset class than, betting on whether a nuclear stock, will, have revenues in 2030 or 2032.
That's fantastic. You mentioned your strategy, you focus on quality. You also talked about your strategy does a very good job at downside protection or limiting drawdowns. And I'm sure that's one of the benefits of investing in quality names. And this is evidence, according to PSN and Zephyr, you have much lower maximum drawdowns compared to the benchmark, lower pain index, higher pain ratio. However, you slice and dice it over this 10 years, your drawdown statistics or capital preservation tendencies are very good. Is that an objective of your investment thesis, or does that just happen because you're investing in quality?
My perspective, it is because we've invested in quality, and it gets mostly to balance sheet strength and cash flow. And if you think of a micro cap company that you get into a challenging environment where the capital markets freeze up, or where bank lending is harder to achieve. If you're dependent on that outside financing to run your business, then you're that the stock of that company has much greater downside risk because they're dependent on the capital markets to fund their operations. So that's why, our criteria of understanding cash flows, balance sheet strength is so important. And it really helps preserve, our clients' downside risk when things get tough or tighter or more challenging.
Yeah, fantastic. I often talk about when I work with financial advisors and do content, how important it is to look at rolling returns or whatever, whether it's returns or any other type of investment metric. versus trailing returns, trailing periods of 1 year, 3 year. And this is a perfect example of why it's important to look at both, because if you just look at your strategy over 1 year or 3 years, it doesn't look great because of recency
Right.
bias, right? But if you look at the 3 year rolling returns over time, you can get a full picture of your performance and how it's performed very well against the benchmark and its peers over a much longer time period. So it's a great example. If you don't mind, Conrad, I'm going to use this in a lot of content or research. It shows you the importance of rolling returns and not just focusing on the trailing periods of 1 and 3 years.
Exactly. I mean, you running a concentrated portfolio, you can have a quarter within a year where there's an air pocket, and so with 40 stocks, those occur, and you nailed it. Looking at those rolling returns is so critical, and it helps cut out some of that, as you said, noise and recency bias. And we're quite proud of what we've built at Ranger Investments, and not only on an the absolute returns annualized, and for over a decade, well over 14%, double our index return. And yes, the last year has been really tough, but despite this challenge speculative environment, we're we're as confident in the portfolio as ever, because we know ultimately it's fundamentals and valuation that matter.
Yeah. And that's so important too, is conviction, being confident and not just changing your investment style and thesis for the flavor of the month or what's going on now. You have conviction in your style, you're confident in it, and you're proud of it, and you're proud of the strategy. Conrad, thank you so much for coming on the show and giving us a glimpse inside of Ranger Investment Management. It's been a lot of fun, great conversation. Where can our audience get more information about Ranger Investment Management?
Rangerinvestments.com would be the best place. Ryan, thank you for this opportunity. It's been a really enjoyable conversation, and we encourage anybody that's interested in from today to reach out to us.
Perfect. Thank you so much, Conrad. And thank you, everyone, for listening to this episode of Inside SMAs. And remember, in a world of investment noise, data driven decisions speak volumes. I'm Ryan Nauman, inviting you to join us next month for more SMA insights that you won't find anywhere else. This has been Inside SMAs, the SMA Data Authority powered by Zephyr PSN. Thank you and have a great rest of your week.